you pay $18 a month for Netflix, Spotify, and Disney Plus. For that same $18, a healthy 30-year-old can lock in a $500,000 life insurance policy for the next 20 years. But here's the catch. Wait until you're 40 to buy that same policy, and the price nearly triples. Every birthday you delay, the insurance company charges you more. And by the end of this video, you'll know exactly why and exactly how much coverage you actually need. Let's start with the real 2026 numbers, because most people have no idea how cheap term life actually is. A healthy 30-year-old man pays about $17.75 a month for a $500,000 20-year term policy. A woman pays $15.25. Women live longer on average, so they get a discount. Wait 10 years. At 40, that same policy jumps to somewhere between $47 and $59 a month. Same coverage, same person, just older. This is what I call the delay tax. Insurance is priced on your remaining life expectancy. Every year you wait, the actuarial math gets worse and you pay for it for the entire length of the policy. Now here's where the industry gets sneaky. Walk into a meeting with a commissioned agent and they'll pitch you whole life insurance instead. Same $500,000 in coverage? About $2,237 a year. That's more than 10 times the cost of term. The pitch is that whole life builds cash value. For 95% of people watching this, that's a bad trade. The returns inside a whole life policy are mediocre, the fees are heavy, and you can do way better by buying cheap term and investing the difference in a basic index fund. That phrase, buy term, invest the difference, is the entire strategy in 6 words. Whole life does earn its keep in 2 specific situations. 1, you have an estate large enough to trigger estate taxes and you need permanent coverage to pay them. 2, you have a lifelong dependent like a child with special needs who will need financial support after you're gone. That's it. If you're not in one of those buckets, term is the answer. Okay, so how much coverage do you actually need? 2 shortcuts. The first is simple. 10 times your annual income. Make $60,000. Get $600,000 in coverage. The second is more precise. It's called the DIME method. D, debt. Add up everything you owe outside your mortgage. I, income. Multiply your annual income by the number of years your family would need support. M, mortgage. The full remaining balance. E, education. Estimate what it'll cost to put your kids through school. Add those 4 numbers together. That's your target policy size. Most 30-somethings with a partner, a kid, or a co-signed mortgage land somewhere between $5,000 and $1.5 million. And even at the high end, we're talking maybe $40 a month at 30. Here's the part nobody says out loud. If nobody depends on your paycheck, no partner, no kids, no shared debt, you probably don't need life insurance yet. But the second someone does depend on you, this stops being optional. It becomes the cheapest, most important financial tool you'll ever buy. So this week, not next month, this week, go pull 3 online quotes. Policy Genius, Ladder, Haven Life, whatever. It takes 15 minutes. If you're healthy and under 35, the number that comes back will genuinely surprise you. It's less than your streaming bundle. It's a rounding error on your budget. And it's the one financial decision that gets more expensive every single month you put it off. If this changed how you think about term versus whole life, the next video breaks down exactly how to invest that difference. The specific accounts, the specific funds, and how a 30-year-old can turn $18 a month into real wealth. See you there.